So today we're going to be talking about common money mistakes, and there will be some overlap based on what Judy had shared with us last week, and that's okay. I don't know about you, but I'm a person who learns by repetition, so I like hearing things more than once. There are some compliance things I do have to get through, which is this here, that the information provided is not written or intended as specific tax or legal advice. Mass Mutuals, its subsidiaries, employees, and representatives are not authorized to give tax or legal advice. Individuals are encouraged to seek advice from their own tax or legal counsel. Individuals involved in the estate planning process should work with an estate planning team, including their own personal legal or tax counsel. And now to the information you've all been waiting for. How can I? Great. Okay. So, what is financial well-being? It's having control over the day-to-day, having the capacity to absorb a financial shock, whatever that looks like, being on track to meet financial goals, having the financial freedom to make choices that allow one to enjoy their life. Okay, so there'll be 4 topics we're going to cover today. 1 is managing finances. 2 is mitigating financial setbacks. 3 is staying on track. And 4 is making decisions. And while there will be like a list of over 50 money-making mistakes, I won't be covering all of them. However, you'll be seeing them all on the screen. I do have a pamphlet version of this presentation that I'm happy to email out or snail mail if you'd like. I was like getting something in the mail that I'm also expecting, and that's not a bill. I can also mail it out to you. Okay, so avoid the following money mistakes: not having a budget. And this is one of the things that Judy had shared. This is one of the opportunities I'm saying that there's overlap here. So not having a budget can be a real challenge to meeting your needs, all your financial needs, short-term and long-term. Spending more than what you make, that is something that many Americans do. And that's something to be conscious to work around and make sure that you're not spending more than you're making. We talk about people's money coming in, but also money's going out. Always buying new. Always buying new. There's nothing wrong with buying something new. There's nothing wrong with buying something used. And buying new isn't always the option. Looking at your budget for guidance on whether you should or not and can afford it to buy a new is something to definitely consider. Not understanding the difference between want and need. It's also something that Judy had shared about last time, which is, you have some needs, you have some wants. Deciphering the difference can really make a difference. Do I really need that coffee today, or do I really want that coffee today? Can I make it at home, for example, and save $3, right? What's the reason behind my need or my want? Misjudging big expenses. This is a big one. Let me give you a couple examples to explain what that means. Someone buys a new car and is shocked to discover that the insurance on the car is 3 times what they used to pay for their old car. Or what about the home that you purchased that is advertised as move-in ready, in addition to purchase price of the home, the cost of the insurance and the taxes? What about the cost of the general upkeep? All those upkeep items do add up, like appliances. Things you're going to need to replace in the first few years. Number 6, failing to negotiate. I like this one in particular. The reason why is because I learned that a few years ago. Not everything is negotiable, but many things are, but you'll never know unless you try. Next time you call the cable company about an issue, give negotiating a try and see what happens. You'd be surprised. Not taking advantage of discounts. So I don't know about you, but before COVID, I was using Groupon a lot. It was making it more affordable for us to go out to eat a couple times a week, right? One of the things that paying unnecessary fees. Did you ever notice that if you return your Netflix DVD back after 9 p.m., they charge you a fee? Yeah, watch out for that. That's a game changer. Number 9, not knowing the slow leaks. I actually call these the silent suckers. And you don't know what you're actually paying extra for if you don't take a kind of closer look. Did you ever notice that the cube, so your cell phone, You tie your cell phone with the cord, and it goes into the cube and the outlet. If this cell phone is not connected to the cord, but the cube is still in the outlet, you're actually paying for electricity that you're not even using. So literally money is going out the window. So that's something to stop doing. It's amazing how much you can save up by just doing that one change. I actually have a client who I had pitched an idea to about, not having all the lights on in your apartment. He tried that homework assignment for 1 month, and he came back to me 5 months later. He says, Kathleen, I can't believe what a difference it made. I said, really? He says, yeah, I had the bathroom light on, the kitchen light on, a couple lights on when I was watching TV, all these extra electrical items on. And I stopped it for 30 days. I said, what happened? He says, I saved $60 on my electric bill. It's amazing. Not planning for irregular expenses. We all know that certain monthly bills each month happen. So it's good to budget for those. But what if we forget to budget for irregular things like the non-recurring that just happen? Expenses like changing the oil in your car every 3 months instead of every single month. With these types of expenses aren't planned for, but they can catch us off guard. Spending frivolously. Pretty self-explanatory here. It goes hand in hand with our discussion about the wants and the needs. Having too many never-ending bills, never-ending payments. Think of your phone bill, your cable bill, and your electric bill. These payments never end and usually never go down. Many of these necessities that we have to have are mistakes that we can make when acceptance of the recurring payments become routine. We lose sight of things we're paying for unless they're become automatic. And we're going to come back to that on making things automatic, by the way. Not paying attention, not paying attention to interest rates. So paying off high interest rate cards faster. So does everyone have a piece of paper? If you don't, can you grab them, please? Going to pull this up ahead of time. We're going to do another example that we did last week. On interest. All right. Can you see my screen, by the way? Sharing PowerPoint. Okay.
Yes, we can.
Okay. Can you see the PowerPoint presentation?
It's still the managing finances, not paying attention
okay.
to the numbers. Yes.
Perfect. Thank you so much, Judy. Appreciate that. So not paying attention to interest rates. On the piece of paper, I want you to write credit card A and credit card B, please. Credit card A, I would like you to write $2,500. And then I want you to write the interest rate is 15%, 1.5. Then please write down credit card B. And that balance is $5,000. And I want you to write down 25% interest, please. Okay. A lot of people feel that they want to pay down the $25,000 debt first, okay, because it's closer to get paid off. It's closer in the future. However, the mathematics shows that if you, let's say you pay your minimum for credit card A, pay the minimum for credit card B, if you have $20 left over at the end of the month, which may not seem like a lot, right? Yeah, it's $20. What's it going to do? It's going to do a lot. Put that $20 toward the higher interest credit card bill. So put it toward credit card B, right? It's going to whittle down that amount quicker, all right? And you save in the long run, okay? Because you're paying more interest rate on that one. All right, so keep that paper handy because we're going to be coming back to that. Not reviewing monthly statements. I actually have something in my calendar that tells me, hey, review your credit card statement in about 10, 12 days before it's due, because I've gotten caught short where I forgot to check my monthly statement because it comes to me electronically and I just didn't see it and I got hit with the charge. So don't miss payments. They really come back and they can be quite costly, okay? Overspending on gifts. So one of the things we actually do is you can actually set up a little account, right? Overspending gifts. My apologies. This can also be called keeping up with the Joneses or keeping up with family. We often feel a pressure to give gifts of a specific monetary value. Many of us overspend on gifts for myriad reasons, But think about the last holidays season. Oftentimes our gifts, which may have cost a pretty penny, sit on a shelf in the recipient's home unused. Or worse, we give cash and you give them too much, okay, that we couldn't afford. When it comes to gifts, give from the heart, don't give from the wallet. You and they will be much happier. I'm actually going to take a pause for a minute and ask if there are any questions.
Brilliant. Thank you so far, Kathleen. We do have one question from the chat. How many is too many never-ending payments? If they are payments like phone bill, what do you do instead?
Can you say that again?
I'll pop it in the panel. You should see that question come through to panelists in the chat. How many is too many never-ending payments? If they are payments like phone bill, what do you do instead?
Well, you can always call the phone company and talk with them about that. We actually have, like, I don't think it's for our phone though, a budget plan. So especially for the bills, and if this is not answering your question, God, let me know. Especially if the bills are like they go up and they go down, like heating and electricity, right? How much do you use depending on the seasons? You can call the company as long as you've been there for 12 months. You can ask them, hey, I want to be put on a budget plan, okay? And what they'll do is they'll take the last 12 months and calculate the average. And this way your bill is going to be the same for every single month. Does that help?
I'll let you know if they run back in. One thing I would just add to that maybe is that I did have a one cell phone company and I was paying 150 for 2 lines on it. I went and looked at a bunch of other companies, called them up, and now I'm paying $80 for exactly the same service. So definitely make sure you shop around. Just because you've had one company for like 10 years doesn't mean that they're the best company for you. So you want to have a double check. Obviously, I'm not going to name any companies here, but you know there are lots of competition out there and you can definitely save some money on your cell phone bills. Same with TV and all other things like that, if that's what you're referring to. And the person got back to me in the chat and said, thank you very much. So I think
That's great. Great. And thank you, Stuart, for jumping that in and explaining that. That's really, really great. Thank you for bringing that up. Okay, not having an emergency fund. So I know Judy had talked about that last time. We actually counsel people to have, like, an emergency fund where it used to be 6 to 12 months, and that was even before COVID. But we've actually had to adjust that to say like 3 to 6 months. So look at your monthly bills, right? And whatever that is, multiply it by 3, then multiply it by 6. And those are your goals to have in that emergency fund. And make it accessible. Don't make it too far removed from, if something happens, you can't get to it. You've got to have it like in a bank, right? Where it's, sure, it might be accruing a little interest, but it's still there. It's attainable. It's used. It could be used both ways. You could also put money in there regularly, okay, to build that up. You could also talk to your bank tellers. You could talk with Judy about how banks would actually show you tools that'll help you to make it automatic, right? And then make that account in your control. Having one source of income. I reluctantly want to share this because I don't want you to feel like you have to have a second job. All right, that's not what I'm saying. But if there was something that you did want to pick up that was side, like some people will like go online and find that they can do a survey, be part of a group of people and get a $20 gift card just for the participating. Okay. Not understanding employee benefits. Oftentimes financial setbacks occur during medical reasons, right? Whether it is a serious illness or you need for a less serious illness, something comes up, an expense, root canal, turn to your employee benefits and see if they can help. All right, I mean, you're paying into it. Why not exercise your rights? All too often, we're unaware of the insurance and the ins and outs of the insurance coverage that we get through our employer, and only find out too late that a procedure isn't covered. Take the time to truly understand your benefits now while you're healthy, so you can make more informed decisions later when you need them most. Carrying too much credit card debt. This is one of those examples of money mistakes that you can fall into one of the 4 categories that we're talking about. We've included it here for the simple reason that in an emergency situation, you may basically need to rely on a credit card. If you have too much debt on a credit card already, your card may be declined just the time when you actually need it. So be wise in how you're using your credit cards. Not having an income protection plan. A major financial setback can occur if you become too sick or too hurt to work. And I sound like I'm an Affleck commercial. We have the guy in the cast. That is short term, right? But what if something happens where it's a long term need? So if you look at your pay stubs, you might see something GLTD. It stands for Group Long-Term Disability. If you are disabled at work and you're out on leave, you put a claim in. If the employer was paying for that benefit, but now they're giving you a check, they're actually going to tax you on that check because it's your income. If you work with someone like my company and you got something called an individual long-term disability policy, then a check from your policy that you owned would come to you tax-free. That's something I can talk to on the side if you're looking for more information. Right? So understanding employer's benefits is really important. Number 22 is not having enough life insurance. This mistake can lead to future financial struggles, as we're kind of living through that right now with COVID. And it's also lost opportunities, not for you, but for your loved ones down the road. Many Americans are underinsured. So the question is, are you underinsured? Having too much financial complexity. When I was preparing for today's seminar, this actually kind of put a smile on my face because many of you are going for your PhD. It reads, if you need a PhD in economics to understand your finances, they're too complicated. And when things are too complicated, your room for error shrinks. Okay. So the best thing to do is to keep it simple. Okay. And to make sure that your loved ones understand. Yes, the irony there. I thought it was fantastic. Making rush decisions. I don't know about you, but I don't like it when people rush me in decisions. I was actually at a cell phone distributor on a Black Friday weekend, and they're having a sale. And so I'm like, okay, my phone is like needs to get replaced, and they were rushing me. And they're like, okay, well, you can get like $200 for your phone if you sign in tomorrow. I'm like, sign up by tomorrow night, midnight. I'm like, what? I was really kind of like shy. I walked out. I was like so livid. The fact that they were pressuring me to do it. I mean, not that he was like yelling at me or anything, but I'm like, you're gonna make me make a decision in the next 24 hours that I don't know if I'm really comfortable making. That was not cool with me. I even told him, I said to him, look, I talk to people about the finances all the time. I haven't even asked, of course, that kind of pressure on them. It's just not right. In my professional opinion, and as a paying person. Not having financial goals. So let's talk about money mistakes and staying on track, okay? There's another very critical mistake that people make without financial goals. They'll never keep staying on track for building your savings, planning for retirement, and paying down your own debt. Without goals, you're often flying blind, and you can make future financial decisions more difficult. So saving for the future is very important. So number 26, not saving for the future is really not something you should consider doing. Let's circle back to making things automatic, okay? Every paycheck you could yourself, when you get paid, take $5, take $10, and just put it in a separate account. Call it your rainy day fund, call it your spa day with your friends, whichever, okay? You can make it automatic where your employer, I have a client who has her employer, direct deposit into the main family account, right? But then she's like, you know what? I want $50 for myself. I want $50 going to this bank account so I can have it there and it'll grow. She can touch it whenever she wants, but it's just like a forced savings for spa day, nail day, massages, whichever, right? But making it automatic means she doesn't have to think about it, doesn't have to revisit it, and it's going to continue to grow. Not taking advantage of your full employer 401k match. This is really important. I mean, everything is important, I understand, but this is truly important. Employers may give a match. We're finding that less and less employers are doing that, but they're also not like giving a good match. Like I have a client who gives like it's like a 7% match. That's crazy amazing. A woman came in, was referred to our office, and she's now moved to Connecticut. She lived out in California, and she is still doing everything on Zoom. Because she's still an employee there, she's getting her retirement matched up to 4%, which is incredible. She said, great, let's move it here to New England Financial Group. I said, whoa, hold on a second. Are you still working there? And she says, yes. Are you going to continue working there? She says, yes, as long as they could still do Zoom, because now I moved to Connecticut. So great. My team and I said, keep it there. You're getting a 4%. You put in 4%. They put in 4%. That's 8%. That's incredible. That's free money. The extra 4% is free money. You're like, and she's 61 years old, so she doesn't have a lot of time, right, for the money to grow. And I looked at her and said, it's like you're catching up on some lost time because you had the extra person, the employer, putting in that 4%. Not only having a short-term outlook, but you also want to have a long-term outlook, okay? So have those goals in place. When it comes to finances, you need to have both long-term and short-term. Keeping your eye on the short-term is important, of course, but it shouldn't be your sole focus. Long-term planning is crucial in your finances. It's also a great motivator. You can get excited, make a poster board, a vision board, and put a picture up there. You know, have it be visual, have it be something you're going to think about daily. Not changing plans with the times. All right, so change is inevitable, right? And especially with today's technology. Change seems to happen on the daily. And most importantly, you and your loved ones need changes too. Well, your financial priorities should change when you do. Flexibility in finances and the ability to make changes is a critical consideration.
Kathleen, we have a question in the chat. If you don't mind, can I interrupt you for a second?
Yes, please do so.
Fabulous, because it's to do with what we just discussed about the 401ks. The question is, if you are a contractor and the 401k is offered through them, should you wait until becoming a full employee to start one? It sounds like you can transfer it to different banks, question mark. I'll put the question also to all panelists so you folks can see it. And those folks who want to send questions, you can also send it to all panelists, not just to host. I'll happily send this through, but if you send it to all panelists, then our folks can see it as well. So hopefully you can see that now, Kathleen.
I can't necessarily see it, but I did hear the question. It's a really great question. When you say you're a contractor, I wonder if they're a W-2 employee with the organization or if they're not, if they're 1099.
If you'd like to post that in the chat, I can, the person who posted that question, then I can.
It sounds like a 1099, I think, Kathleen.
Oh, but she said, Sandy, I think, said it's W-2 employee. That's a really good question. So I'm remembering the question now. Can you reread it again, Stuart?
It is, if you are a contractor and the 401k is offered through them, should you wait until becoming a full employee to start one? It sounds like you can transfer it to different banks, question mark. And they said W-2, they said.
I was confused with it sounded like you could transfer it to a different bank. I wouldn't wait. If they're going to offer it to you as a part-time employee, definitely jump on that bandwagon. Yeah, start that now.
And I think that the most important thing, if I might jump in, is just that you do own it. So when you move, you can move it. You can move it to a new plan with the financial advisor. You can move it to your new company sometimes. You can move it to a bank. There are many different areas that you can move it to. You just don't want to take possession of it for more than 90 days because then you can get taxed on it. You want to make sure that it gets rolled over and that you don't even keep a check in your hand for very long. It's usually, I kind of keep it a 30-day window thinking about that. So if you get a check within 30 days, deposit it into a new IRA, a new 401k, a new investment retirement vehicle of some sort, and sometimes with your new company. But you do own it.
Great question, too. And I want to leave time at the end, too, for other questions, as we get through deeper into this, okay? borrowing from retirement accounts, perfect timing, right? One thing you don't want to do is to borrow from your retirement accounts, because if you're under a certain age, you don't only get taxed on it, but you will also incur a penalty. Okay, so you really want to be careful with that. Besides, it's like the best vehicle to, it's one of the best vehicles to like just let it ride and go. And that's what we talk to people about, you know, what can you commit to, even if it's only $20 a month. Okay, what can you put away that it's okay that you don't touch it, right, for many years. In fact, this might be the best time to show the compound interest. So you're sharing Microsoft PowerPoint. Can you all see this calculator?
No, we can't see that unless you share your screen instead of sharing the PowerPoint, and then you'll be able to drag anything onto that screen we will then see.
Let's see if this works. Share.
Yep, we now see a calculator, and we also see your browser tabs as well, just so you know.
Nothing bad. Thank you. Okay. All right. So present value. Right. You have a piece of paper and pencil, right? Okay. Let's take a look at, I like to make numbers easy, right? Because then you could always divide by 2 or 3 to figure out something else that's more appropriate for your budget. What if you did $100 a month? Okay. And you're starting with 0. And $100 a month means $1,200 a year. Okay. Let's say you're getting 6% in there. Okay. You would put in cumulative. You would put in $24,000, right? Over 20 years. What if you had that grow for you? So you had $24,000, but now grew to $46,000. It almost doubled. Okay. But let's say you're 25 years old, you're only going to be 45. So you could technically be in for another 20 years, right? 40 years total. Now, let's put this back to 0. That same 25-year-old, right, at $100 a month for 40 years, put in $48,000. Okay, that's how much you put in. You can find a vehicle that can give you about 6%. It'll grow. It has potential to grow to $196,000. Okay, and that's starting early. Let me do this one. Let me know if you can see there's a new calculator I'm going to use that has.
We can still see your screen. Yes.
Great. Thank you, Judy. So where is my visual? Then they changed the computer program on me. Oh, that's so sad. Because it actually had a graph, which was nice. All right, so let's take a look. Oh, there's a graph. Okay, so $1,200 a year over 40 years. Okay. You're putting in $48,000. 6% interest. How much to grow? By the way, you're the orange line. The parabola is how much it grew. Right? So the blue is the growth. And look at how much you put in, you contributed over that 40-year window. Much smaller. Now, last time we spoke, we said, hey, what if a person in their 40s put it in? So they have 20 years. We'll keep it still the same, $100 a month. Keep the interest rate the same. See how much closer these are? The amount that the individual puts in is close to how much it grows to. So what I'm saying is it about doubles. Just about.
And Kathleen, what if we just shared also a little bit more about if they have their match in there, so they're contributing the $100 a month, so it's $1,200, and then we get to add another $600 for the money that they did not include. So just seeing that difference.
Okay.
So
let's
they'd
go
be
back
having
to
their annual payment would then be closer to $1,800.
sharp curve.
That's the free money, almost $100,000.
I'm gonna see if I can enlarge this.
So while you're doing that, Kathleen, we had a question come in and they were asking, is this an example for a 401k? And I presume you will answer this, but any investment that is yielding interest, this compound interest applies to that. But 401k is one area of that, right, Kathleen?
Correct. Correct. Any vehicle that can be like, and my example is 6%. Yes. Good question. I know it's kind of small, but the principal is what the employee or what you would put in, which is over the time of 40 years, $72,000. Okay. Might seem like a lot, but it's over 40 years. It grew to a little over $295,000. I wouldn't mind that myself. I'm going to stop sharing this screen. I'm going to go back to the PowerPoint. I can figure it out.
And Kathleen, one of the great things while you're getting there is that when people set up a percentage, right? You're setting up, you say, okay, I want to invest 6% of my income. Then as you get raises, your investment will increase and you'll never see it. So those numbers we're not even adding in for your compounding, but thinking about over the course of your career, just that way of investing in yourself without even thinking about it is a great way to really build a strong investment portfolio and a retirement plan.
Gee, that's a really great point. In fact, that's actually a really good opportunity for us to say to people that when they ask you for the contribution, you could put in a dollar amount or you could do a percentage. And if you put in a percentage, it'll grow with you as you get a raise.
One other question I have for you, Kathleen, is you put in on the calculator a 6% per year interest growth. I know when I started investing, I was, looking up and seeing some years are very bad years, some years are very good years, and I was nervous about investing, more of my money into my 401k because I was like, well, what if it's a bad year? I'm going to lose money. Could you talk a little bit about that 6% that you came up with and why you settled on that for the long term?
Good question, because there are vehicles out there that on average because we look at history, we can't say what's going to happen in the future, but we can look at historical data, especially being a former math teacher. Like you just look at the history over a span of 30 years, what's the average interest rate? Okay. There are companies, there are places or vehicles that can give you in the double digits, and there are others that will give you like less than 1%, right? There are vehicles over there that in the span of 30 years, the average interest rate is 7.42% in a vehicle that I'm thinking about right now. Okay. It's just really talking with a financial professional, getting some education. And the financial professional, if you're working with someone who's in your best interest, they're going to ask you a lot of questions. And it might be annoying, I understand that, but we really need to ask you a lot of questions to really understand like where you are and what your process is. And I say that because we'll ask like, what's your risk tolerance? What's that mean? Well, from a 1 to 10, how risky or how conservative are you with your money? 1 is, I'm fine with putting it in a CD at a bank. I know it'll be there when it matures. Versus 10, hey, I'm ready to lose my shirt tomorrow if I happen to. It's okay, I got my other money somewhere else, right? The 61-year-old yesterday said her risk tolerance is an 8. I actually kind of stood up straight and I asked her all the questions, like, are you sure? Just kind of want to make sure that she understood what the 8 really meant. And she says, no, I know I'm very risky, and I have been always risky. I said, okay, so if you're putting this money in here, you could lose it. Like 8 is higher risk tolerance. Like 5 is more conservative, 3 is more conservative. And she looked me square in the face. No, I understand. And that's the thing. We have to ask the questions, those tough questions, just to make sure that they understand what they're saying and what they mean to say. Does that make sense, Stuart?
Thank you very much.
Welcome. I'm going to go down because I really wanted to hit this slide. Okay, I know it's almost quarter of, and I want to leave some time for Q&A, more Q&A. Number 37, not talking about money with your partner. That's really important. And the next thing I want you to write on your sheet of paper is having a family financial mission statement. Family financial mission statement. And the reason why is it really is a game changer. I know a couple who is now divorced in a relationship, and it's very different because the first relationship, the family mission, they were not on the same page. Like one was here, the other one was here, and one was a spender, one was a saver. But no matter how much that saver was saving, it wasn't enough because the other person was spending so much. So they were never on the same page. Now in the new relationship where they do talk, and I'm not saying every single day, I mean like every 2 weeks you get paid, right? Have a conversation. They're on the same page. They're meeting their short-term and their long-term goals. They met with their financial advisor, and the financial advisor was blown away about how close they've gotten to their long-term, and then how fast they actually were able to get to their short-term goals. So talking with your partner, talking with your family members is really important. Not getting professional financial advice is also really important. People say, oh, I can't talk to so-and-so. Why not? I always find it's better to ask questions. You know, it's the questions we don't ask that could really negatively impact us. Not being knowledgeable about finances. Well, isn't that what this financial literacy program is for? Right? For all of us to kind of understand more information, right? I'm learning from Judy just as you're learning from me, right? There's a lot to know about finances. Some of it is very complex and confusing, but the good news is that you don't have to know everything. And just knowing the basics of how to budget, how to create a debt management plan, difference between investment types and impact of interest, just to name a few, can really help you become more informed and make good, sound decisions.